joining us from Cedar Rapids, Iowa. He is the main partner of ISA Ventures, which is the only in Iowa, the only multi-stage venture fund. So similar, that has seed all the way to venture capital. And prior to that, he launched New Boatco, which is a nonprofit organization that serves really all across the state, whether it's entrepreneurship, coding school, entrepreneurship within the corporate world. They're doing a lot of great things. EntreFest is another great event that's coming up here in June that New Boatco helps run. So Eric, if you want to kind of come up here and I'll pull up your slides, but he's really going to be talking about what is this process and what does this journey look like as you're considering raising capital, particularly for equity. So this whole day is really around equity financing, which really just means equity is the ownership, and so it's looking at investors who might actually take some of that ownership to help you as you're trying to grow your business. So with that, I'll bring you up here and I'll pull up your slide. So.
Appreciate that, Diana. Yeah, and before that, I started my own software company and ran it for 15 years. So I'm kind of a technical dork, but not good enough to really write code for anybody. So don't get me on any technical questions. I'll put a caveat too. This fund that we've got right now is a $22 million fund. It's about 18 months old. And before that, we did some very small investing in early stage companies. I'm going to say what I'm going to tell you is one dude's perspective. I'd like to think it's pretty well informed, but there are a lot of different perspectives out there. If you're following VC Twitter, we disagree with each other all the time. So I'm going to give you my perspective and hope that it's pretty representative of the big picture that I think is probably useful for you to know. I've got sort of an outline of an agenda. There's sort of two big pieces. We're going to just do some one-on-one stuff since we've got people at lots of different stages in the room with different levels of experience. And then we're going to talk, kind of hone in on the process. I'm going to leave lots of time for questions. I don't do pretty slides. These are just simple. I'm sure we'll share all these afterwards. I'll also note that I looked at the prior version of this that Diana, you have on the website. And there's a bunch of really great lists and things on there. Like here's a whole bunch of investors around the Midwest. Like I didn't include those here because you can already get those there. So it would be worth checking that out if you're looking for some resources. They've got some great lists already in that deck. I didn't repeat them. A couple of kind of 101 items that I guess I want to talk about. And for today, my thinking here is I wanted to give you maybe the philosophy or maybe the thinking behind the scenes that's not maybe immediately obvious. And when you're looking to raise capital. And this sounds like a sort of cliche that would be on a plaque as you walk into a house. Raising capital is a journey, and it's a painful journey. It's not something that is, at least I don't find it pleasant when I attempted to raise capital. It is complicated, it is confusing, it's challenging, it's very hard to do. And I think a lot of entrepreneurs, especially the first time they go to raise capital, they think, I just got to convince some rich person to put some money in my company and I'm good. As if it's kind of an episodic, one-shot sort of thing. No. The moment you accept capital, you are on a certain trajectory with your business, and you need to generate returns for that investor, and for your friends forever, whether you like them or not, like you're together. And a lot of people don't maybe think about the fact that, okay, we are now bonded legally in an entity together, and it might be 5, 8, 10 years, you got to be maybe not friends, but at least cordial and build that relationship with those folks. So just want to maybe start with that observation if you haven't considered it from that perspective before. The other piece of this is, I think a lot of founders go at why the hell am I raising capital to begin with? I think there's a bunch of good reasons for it. It might be because if you want to build this business all on your personal wealth, such a wealth you may or may not even have, maybe you want to spread that out among some investors. It might be that you just want to grow faster, which I would suspect everybody in this room would probably say fits. Sometimes it's just to buy time to figure stuff out. You've got this idea, but you're asking an investor to say, hey, give me $100,000 so that I can build this prototype and get this feedback from some customers so I know where to go next. Basically that cash is necessary for you to do this and you're willing to share your ownership in the company to get there. And I think the other piece of this is you're really willing to sell some of that in a time period that makes sense for an investor. All those things kind of are probably wound up in what you're doing, but here's maybe why I put this as the very first slide. a lot of times when I see entrepreneurs pitching us, what they're pitching is kind of confused as to which one they're doing here. Why is it that you're raising capital? And I'll go into maybe some examples of what it should look like later. But I want to shift that around and look at it from my view. My job is to make money for my investors, period, point blank. As much as I love you, you're my friend, I care about my community, my state, whatever. My job, I got 100 rich people who gave me their money, and I got to invest it in the best possible places that I can. And if I don't, they get real mad at me. Yeah, so my job is to deploy that money as best I can. That's also how I make money. Sometimes it's to help you. In certain stages, those early stage investors, you might find some altruistic investors out there, typically the angels, but pretty much no VCs are in it for that. This might be some, wealthy doctors or bankers or something in your town who are like, I just really want to see you be successful. I'll put 50 or 100 grand or whatever into your business. But it's important that you understand, what does the other party in this transaction want? Very clearly. Generally speaking, they're going to want to make money. So once you start this path, as I mentioned, this is like a treadmill. And the treadmill doesn't stop. The moment you take 100 grand from an angel, that treadmill starts kind of rolling slowly. And you're like, oh, I gotta move. It's moving under my feet, I can't even stop it. And as you raise more and more money over time, that treadmill accelerates and continues to go faster. And I think a lot of entrepreneurs haven't really considered what that looks like, because again, once you head down this path, it's kind of a permanent decision. It's really critical that you kind of keep that in mind. So I wanted to give you some ideas of things that make a business fundable. And honestly, raising capital, decisions that investors like me might make, it's as much art as science. I want to believe that it's all math driven and there's some magic formula behind the scenes that tells me I should bet on that one, maybe that one, definitely not that one. That's not quite how it works. There's a lot of factors involved here, and investors are weighing a lot of different pieces. Examples include, a product that is so clear and compelling, I have to have this. Like, this is brilliant, I need this to exist in the world because it just needs to be there. It might be traction. You're showing me a curve of revenue growth that's, wow, obviously whether I believe in the product or not, I see the traction, people want to pay for this. As an investor, that's incredibly compelling, that I want to see that traction, evidence from real customers paying to solve a problem. You've got some sort of a scale efficiency built in. This is why investors tend to like software companies, things that can scale very easily with very low additional capital requirements to get to where they need to go. We look for things like intellectual property protection or some other reason that might prevent a competitor from coming in and just copying what you do. There are accelerator programs in the world that are basically built on the idea that we're going to watch other accelerators. We're going to fund a team to just do what that company that just went into that accelerator did. And that's the business model, which is terrifying and brilliant at the same time. But you need a way to prevent people from getting at what you're building. We like to see competition. I want to see founders who understand the competitive marketplace. Competition means there's other people out there who've also sniffed out this problem and probably found customers who also want to solve that problem. We're looking for big markets. Doesn't necessarily have to be $1 billion in my case, but typically venture funds are looking for monster potential market sizes. They're looking for a team that's experienced, that can grow with the job of being a founder in a company that's venture-backed. At the very end, if we have time, I want to speak about what that really feels like to be a venture-backed founder. In a timeline that's appropriate for investors. Some investors are more patient than others. In our fund, for example, we're just under 2 years into it. We have a 10-year total time horizon. So I need to believe that you could sell this thing in the next basically 7.5 years, 8 years, for this to be worth investing in at all. If it's at the early stages of some drug discovery or something, it's not going to fit our profile. And every investor has a different time horizon for when they're investing. If you're catching them 5 years into a 10-year time horizon, their time horizon is different too. So it has to kind of match up with where they're at. I want to see alignment around the end game. When I'm talking to an entrepreneur, I want to make sure that they understand what I want as an investor, and that we're aligned around where we're going here. The goal is to build it and sell it within X time frame, and we understand that together. There's proper structure. Dealt with a lot of this recently with founders who get sort of started on one path and we have to clean it up later with their lawyers to get it ready for investment. And then finally, we're looking for a little bit of luck, or maybe the idea that the founder might find some luck. I've backed some companies where it was my favorite bet in the pool. I thought it was going to win, it didn't, and then the kind of random one we picked up turned out to be the one that made us a lot of money. It's an interesting, as I said, it's a lot more art maybe than science. But typically as a founder, what you're trying to do when you're looking to build a business, these are the kinds of things you might want to be thinking about. It's not an exhaustive list, but these are things you probably want to be thinking about as you start talking about raising capital and meeting with investors. I want to throw out one other thing that I think is really important here, especially for first-time founders. They approach this as if I am the lowly, adorable, cute founder trying to build my business. There is some rich, powerful, very smart venture capitalists, and I need to convince them to love me. My job is to win. I want to win their capital. And they approach it from this position of deference. Here's the secret thing. You are the sexy bits in the room, not the venture capitalist, right? The venture capitalist is a checkbook with maybe some smarts they add to it, but at the end of the day, you are the constraint on the system, and you should approach it from a confident position that you are the one that gives them the ability to make a god-awful lot of money if you do your job right, okay? So when you position and think about how you're approaching investors, come at it from a position of confidence. You want to help everybody win a lot of money at the end of the day. Founders need to think about how much they want to raise, and particularly from my perspective, I see it as two things we're looking for, two options you could communicate to an investor as you think about how much you want to raise. For most of you, I'm guessing you have a long time horizon, multiple years. You're not going to make money for a long time. That's sort of the classic venture approach. You're going to set out a series of milestones that maybe get you to where you want to be, and you can anticipate in advance. There's going to be a series of investments. So it might be your Series C, then A, then B, then C, and then an exit down the road, because it's just that big and it requires capital to build that much. And that's pretty typical. But what's important is, I think, as you think about how much you're going to raise, I'm going to hit this point a couple of times today because it's really crucial, frame it in the milestone that you need to reach and why that milestone is what takes the business from where it is to the next level of value. It makes the company more valuable, okay? The other possibility is, all right, I just need to raise capital to get me through this cash period that gets me to profitability at some point in the future. And I'm 90% or 80% confident that $1.7 million gets me there, so I'm gonna raise $2.5 million to have a little cushion, and after that I don't need capital anymore. But you kind of have to choose which position you're going to be in. It's either one of a series of raises, or this is the terminal raise where after we're profitable and I don't need capital anymore, maybe you'll be exiting at that point in time. But that's largely how you do this. The amount you're raising comes from a spreadsheet that tells you what it takes to reach a milestone or what it takes to reach profitability. But here's sort of to hit that point a little differently. This is a common sort of framing that I personally dislike. I'd be interested if other investors would have the same feedback, but they'll say, I'm here to fund 2 software developers, a marketer, and some HR expense and whatever. Like that is exactly not what you're asking me to fund. I'm not excited about funding random staff for you to do some stuff. What I want to know is, where are you going to take this money? What does it get you? And how confident are you at that point you can go raise your Series A? Your Series A doesn't come because you hired 2 developers. Series A comes because we developed a prototype, we tested it with 50 customers, we got this level of interaction, we generated this much revenue, whatever the sort of position is you want to be. But this is where it starts to translate from a pitch into a strategy, right? This is your hint that I have a plan, and the plan is to go to here first. This is my next spot on my path, and I can clearly communicate why that spot is important and why it makes it likely I can raise capital. And then there'll be another one after that. But it's not, I'm gonna just buy me some runway. It really is quite the turnoff to me. You're probably familiar with kind of high-level types of capital to raise. This might be different on the coasts from Iowa. I should have mentioned this, but our fund only invests in companies who are located in the state of Iowa. So I'll be totally honest with you, my worldview is like blinders. If you're in Illinois or Minnesota or wherever, nice to know you, but I'm not going to focus a lot of time probably on you. That also keeps me a little bit focused. So I'm going to keep this reference to where the Iowa ecosystem is, but broadly these will probably hold true everywhere. Probably 3 major types of capital that we see out there today. A simple agreement for future equity, a SAFE, is a really common one. The point of it is that first word of simple. This is a templated document, it's easy, it's fairly fast, and it really just is a way for investors to get money into your business early that converts later into equity. You should use the standard templates. Do not modify the templates. The moment you modify the template, it is no longer a simple agreement for future equity. It is some custom random stuff you got to pay a lawyer to unwind. So just keep, if you're going to do a safe, use the YC post money safe that's available on the internet. There's a couple variations we can talk you through, but for all that's good and holy, don't edit it. The second thing that's pretty common around here is price equity. This is probably the most common and probably the most preferred in Iowa with Iowa investors. They just want to know, how much is this company worth? I'm buying some shares of your business at a specific price. This is what I want to pay for it. There's a negotiation there as you come to that price, but that's a way that makes it very simple. In a safe, you don't necessarily know the price. There's a cap in there and some discounts potentially, but with the price equity round, you've agreed in advance, this is what the company is worth today. This is what I'm buying based on its future potential. It's worth it to do that. The third type is a convertible note, which is basically a loan that then later converts into ownership in the business. In Iowa, those are typically, they have been common in the past. I see them becoming less common recently in favor of safes, which is our preference. But probably the first two are the ones that I would say are most commonly used in Iowa. Curious if other investors in the room have other perspectives, or there's so much more to talk about here, but just curious if you have anything you want to add to that. Yeah? All right, we'll save it for Q&A if you want to debate me on any of those things, which is great, because it's fun. You're probably familiar with different types of investors out there. This is probably the most common categories. Basically rich aunts and uncles, angels in the community that you maybe didn't know in advance, institutional investors with firms like ours, or strategics, which might be a customer or a distributor or something that invests in your business. There are pros and cons to each one of these. But typically these investors approximately fall in these categories in my experience. Your mileage may vary, but at the early stages before you have anything, typically the only people who are going to invest in your business, usually early on, is friends and family or maybe angels. There are programs like accelerator programs which kind of fit kind of in the middle there. But the idea is that most venture funds are not going to write you a really big check at what would be classified as pre-seed. That would have definitely been true years ago. Today, the world is kind of getting very different. There are a lot of VCs starting to sprinkle money at that early stage, so that there is a box there where I think that can happen more commonly. But usually what we see is sort of at this seed stage, which I'm guessing for those of you in GIA, maybe you classify yourselves at that point. You've got probably a prototype, maybe you have some early customers giving you early feedback. You've figured out kind of maybe the core mechanics, you've got a financial model probably, or you will soon enough. That's typically where venture funds start to come in. Angels follow in many cases at that point. And then by the time you get to Series A, that's usually where strategic investors, in some cases, can be involved. And that's an option for you to consider. So this might be a big corporation that has its own corporate venture fund, and they're looking for a place to deploy capital to help you grow and potentially to acquire you down the road or to ride the upside with you. In my experience, this has been kind of the common sort of framing for this, but again, there are a lot of wild experiences out there that are different in every scenario. But there are lots of pros and cons to each one of these that are probably worth considering. Your friends and family, probably they're doing it because they love you, and they hope to God they'll get something back. That's probably the real reason. So you're setting the terms probably, maybe there's a little bit of a negotiation there. If you're working with angels, usually you're setting the terms or at least articulating what you're intending it to be. Sometimes the angels will come to you with a specific offer. If it's a venture capital firm, usually there's a lead VC. So those of you that have gone down this path, you've talked about having a lead investor. That's someone who's taking a significant portion of the amount you're looking to raise, and they kind of get to call the shots, and everybody else kind of follows the leader because you want everybody on one set of terms in your investment round. If you're a strategic investor, they're going to be setting the terms on almost all the cases, unless they're usually going to effectively be the lead investor at that stage, at least in my experience. But board seats are something that founders often don't think about. Boards are awesome and terrifying at the same time. I'm on many boards, have been on many boards. I've been a founder with a board. A board position comes with power, voting power to do things. Early on, it's not enough power to maybe do anything, but by the time you get to Series A, sometimes the board can fire you. And as a founder, you maybe don't realize early on that that's what's happening, but as you kind of get on that treadmill and it starts speeding up, you realize, oh, As part of this round, I now have 3 board members who can outvote me in certain matters and could replace me if they wanted or make my life miserable if they decide they don't like me anymore. And a lot of people as founders, the reason you start a business early on is because you think, I want to call my shots. It's my turn, I want to lead. And then you have a board that can fire you. So just be careful as you think about, as you work down that path, that it doesn't come up until often too late. But that doesn't really usually manifest until you get a venture fund involved. If I'm going to invest 100 rich people's money and put millions of dollars to work in your business, dang right, I'm going to have some important control in that boardroom as part of the deal, or a peer investor is going to have that. There are a lot of pros to raising friends and family early capital. Again, usually they love you, so they're going to be very patient. 15 years later, when you haven't paid them back and they're like, I've seen the stock market since 2009 go where it went, and I still haven't got my money back. Could have put that in there instead. They still love you, I hope they still love you at that point. They're usually very patient. Angels are sometimes patient. Again, it depends on their motivation. It's important for you to understand what they want, but sometimes they're patient. Venture funds usually not so patient, but they do bring with them usually experience, especially in the governance realm, of what it looks like to take a very fast-growing company and add value in a capacity that helps you be a better leader as you run the business. They can often, the strategic investors can often bring customers and distribution channels and things like that. We have an investment we're finishing right now. It'll be our biggest one we've ever done. It's a company with a strategic investor involved that is essentially has a global distribution rights for their first product, and they're going to take it to market for them. They don't have to hire a sales force. They don't have to put all that together. They just make the product for their first version. And then as they add maybe a second or a third one, they can have other options. But it's a hugely powerful relationship. Each one of those comes with some cons, though. Your family reunions can sometimes be complicated if things are not going well. Those relationships, your friends and family are probably more important to you than your business. So it's important just to keep in mind that those relationships can get frayed. In my experience, a lot of angels are really, really good. There are a lot of angels who are well-intentioned but not that helpful to you, but they think they are. And you have to be able to discern which that is. Venture capital firms are usually valuable to you, certainly from a cash perspective, but once you're on that treadmill, that venture capitalist is going to be driving you, wants performance, they want their money back. And that becomes a very loud voice in your ear that you can't get rid of. They're with you, and they're going to have that seat to do that. And again, it could cause changes of control in the business down the road from a board perspective. Strategic investors, there's one downside that I've observed, at least a potential downside, is if you get intertangled with one major player in your industry, does that preclude other people from buying you because they're a competitor of that company, for example? So there are a lot of dynamics in play, and there's much more to this, but I just want to kind of lay out, here are some of the common forms, maybe some pros and cons of different kinds of things. Valuation is also a bit more of an art than a science. A couple of factors go into this. Some investors come at this from, I need to own 10% or 20% of the business, therefore, if I can invest $2 million, that makes the price approximately this much. And that's how it's approached. That's the only option on the table. A lot of investors are extraordinarily limited in the valuations they can even invest in. We have some good friends that one in Chicago, for example, that are basically, if you hit past $8 million post money, like it's out, we don't invest anymore after that point. And they're very clear with founders who come to them and say, well, I want to raise it $10 million. And they're just like, nope, goodbye, have a nice life. Which is fine, and that's part of the negotiation. The second is the investor's belief in the value of the business today, balanced with the value of where it's going to be in the future. Right? As an investor, I look at it if I'm going to buy 20% of your company by putting $1 million in it today, which is just fine, but I'm balancing that against what I think it's going to be down the road. And so sometimes there's wiggle room if I believe the value down the road is really high. That makes me want to be a lot more negotiable than when I'm not so sure about what the potential of the future could be. The market is a piece of this. I envision someday having, for the folks in Iowa, this gorgeous scatter plot of every investment we've made by valuation and revenue at the day we invested, to sort of just present to you the 38 companies we've invested in and see that really clearly. I can give you some benchmarks if it's useful. But the point is there's a market out there, and investors are the other party in this market between your companies selling equity and us as investors. There's a market out there. And right now the market is weird, especially outside the state of Iowa. It's very frothy. If you're watching some of the stuff going on with the companies coming out of like Combinator, for example, it's a very interesting mathematical model for funds like us or funds of our size coming out of there with really high valuations. So the market drives a big piece of what the valuation really is, and then ultimately it's your leveraging power or your negotiation power to leverage in there. If you have some, if you can demonstrate that you've got investors who are in at a certain price point that's higher than maybe I want, but there's only $250,000 left in the round and I miss out if I don't go, yeah, we might do it at a valuation that's not where I would have preferred it. So all of these factors kind of come into play. I think the short piece of it is ultimately it's a negotiation, and it's complex, and especially when you're blind as a founder if you've never done it before. Typical deals in Iowa look something like this. This ebbs and flows over time. It's sort of at this pre-seed stage, often it's $500,000 to $1 million valuations is what we're seeing. Again, I would classify here pre-seed as companies that are, we've got an idea, maybe a early mock-up, maybe some feedback from potential customers, right? This is definitely pre-revenue. We typically see them in that, but we've seen them up to $3-5 million in certain situations. There's a bell curve in there. Those companies are typically looking for $25K to $250,000. Often in Iowa, a whole array of programs, as Diana sort of hinted, maybe you all know about, that you can borrow money from the state, different grant programs and things like that can double, triple those numbers pretty easily. But typically, founders at that stage are giving up 5, maybe 10% of the company at that point. And the revenue is usually pretty negligible. Kind of jumping up to the seed stage, you'll see a pre-money valuation 2 to 4 is again kind of maybe in the middle, but we've seen some in the 10 range in there, depending on kind of the deal that you see. In Iowa, typically looking for around $1 million plus or minus at that point, depending on what you're doing, depending on the business, capital needs, whatnot. But typically, founders are selling in the neighborhood of 20% at that point, and usually they've got some pretty solid beta traction at that point. Like we'll be able to see pretty clearly there's something cool going on. People are willing to exchange money for this. We can see some early repeatability in what you're doing. By the time you get to Series A, though, that's when stuff's pretty real. That's when things are extraordinarily complicated and competitive. You might be looking at a valuation from 10 to 40 million, looking to raise 1 to 10, depending on, again, that's just sort of the typical example, selling another 20% of the business. If you're kind of doing the math here, though, you're kind of seeing, I'm selling significant chunks of my business as you're going here, right? It might be up to half or more of the business by the time you get to Series B, which is typical. Again, there are examples extremely much higher than that. I've seen some pretty abusive examples of people selling half their business in the pre-seed stage. Don't do that. But I've seen some where they maintain easily majority control way into Series CD, depending on the negotiating power that you have. But anyways, this just gives you maybe a rough framework. Again, I'd love to have that beautiful scatter plot for you. I will eventually get that built out. One of the things that is really a big thing that we look for in founders is, do they understand how to be organized with this stuff? If we have to coach you through getting everything organized, putting it together from the beginning, it's a real pain in my ass. This stuff is not rocket science. You can go Google, and in fact, the stuff that Diana had last year in this program has a great example of a of a deal room structure that you can use. There's a bunch of examples online, but if I say, hey, we're pretty serious about working with you, show me your deal room, and you have it all set up, all the financials are neatly in there, you've got some profiles of your team members in there, you've got some of the legal documents in there, so I say, oh, these people have their crap together. It speaks very highly, I think, of you as a leader just to have thought that far out. A lot of founders don't until after the first investor says, hey, can I see your deal room? It can be on Dropbox or whatever's convenient for you. But it speaks very highly of you to have most of that together before you come to us. And again, it's not rocket science, it's just getting your stuff organized. You probably have it all. You just haven't put it in a way that's digestible for a third party. The other piece is just to get your cap table organized. There'll be a whole session later today on cap tables, but we're big fans of founders who have their stuff up in Carta. Carta has a platform that manages all that for you, and at most of the stages you're at it will be free until you get so many investors on that cap table. But having that stuff very organized is graceful for us and makes the math much easier for you. You can run scenarios and other things in there. It's beautiful. But I think that's one of the messages as we start to shift toward process in a moment here of just staying organized is a key piece of this for your sanity and for investors. So I'm going to kind of shift gears now and talk about the process in a little bit more detail and more from a sequence perspective. At a really high level, these things overlap. These don't happen in sequence. The whole thing, 3 months to 9 months is what I've seen typically, but I've seen some take more than a year easily, depending on the round. So again, these are not sequential. It doesn't mean 30, then 90, then 180. These things happen in and on top of each other. But this one has to happen before you can even start this one. Okay? But then they start to overlap. So first big step in here is to find some investors to talk to. I only invest in Iowa companies. We prefer software and hardware. We're somewhat industry agnostic. We have a heavy tilt toward agriculture, as you might imagine, in Iowa, healthcare, education, finance, certain things like that. We don't really do crypto, not in NFTs, not my thing. And if you're in the Philippines, why are you emailing me? And so people do this all the time. They send emails to us saying, hey, look at my business. And I'm like, you didn't even spend 30 seconds on my website. I don't even respond, right? So find the investors that you're targeting. I'll give you some tips on that in a moment. We're going to go through each one of these in a moment. Once you found somebody you want to talk to, then you need to reach out to them. I'll give you some tips on maybe ways to reach out to investors, but that's I have to bolt that extroversion spine on my back if you're not an extrovert, to go reach out to people, cold calls sometimes, emails, things like that. Then you get to the pitch where you get to say, here is my story. You wanted to hear my story. I will tell you my story and why I am the best option on the table for your precious dollars. Then we go through a series of deep dives with you to dig out all the stuff. This is where we crawl all up in there and ask you lots of uncomfortable questions. Then if you're lucky, you'll get more than one term sheet and you will compare them to each other and pick the best one that you want to negotiate to move into final diligence and closing. This is a very simplified view of the process, but this is how we think of it at a high level as investors. This is how we see founders approaching us. So let's start with kind of that first one, finding investors. As I mentioned, on the Greater Des Moines Partnership website, they have a great list on the deck that was done last year, a whole bunch of investors around the Midwest. You can look through that. They're pretty easy to find investors these days. But it's a really big thing for you to know where do they like to focus, at what stage, in what industries, and am I a match for that? It's embarrassing for you to just randomly reach out when it doesn't match. Please do some research. It's a waste of your time and a waste of an investor's time. But the other piece of this is to think about how to engage them. I think a lot of entrepreneurs just figure, I'm going to sit at my keyboard and I'm going to bang out an email template. I'm going to send the same template to every single investor. I would encourage you not to do this. There are a lot of different ways that investors like to engage with potential founders. And most of them, I would say most venture funds in particular, and most angel investors are probably pretty flexible. But they certainly have places where they're at. Just like any sort of marketing effort you might do, you need to go where your customers are. And you can often determine how they like to engage with founders. So a lot of times you go to their website, it's going to tell you, pitch us. Here's the link, here's the email address, whatever. Here's the simple form to get started. They'll have some kind of an intake process. I just want you to see this maybe from my perspective, and we're a pretty small venture fund. We probably get 50 to 100 inquiries a month. And again, most of them are junk that is not even in our bailiwick, and so we don't even answer them. But the probably 20, maybe 30 that are in Iowa that are at different stages just reaching out to reach us. We have to manage and vet all of those. So our preference is we'll say, hey, awesome, would you fill out this, even whether you email us, you tweet us, whatever it is, we're going to say, hey, would you fill out this form for us really quick? Just give us a couple data points so we know how to think about you, and pretty much we'll take a pitch with you in almost every case. We're very narrow in our focus. A lot of investors maybe aren't quite as permissive in sort of shifting from reach out to pitch stage, but we pretty much will hear a pitch from almost any investor or any founder who's otherwise qualified in the state of Iowa because it's a small pool. But if you reach out to us on Twitter based on something we said there, if you reached out to us on LinkedIn based on something we posted there, it's like, all right, cool. We're at the very beginning of building a relationship. That's ultimately what you're doing when you court an investor or try to work with an investor to decide if there's a good arrangement to be made. You're trying to build that a relationship. And a lot of VCs are very active on Twitter in different ways. And they'll often give you great ways of saying, hey, DM me if you're interested in meeting up for coffee or whatever. That's very, very common. And I'd encourage you to think about it that way because it's probably faster than the monster inbox of emails that just goes somewhere, right? Figure out what way they like to communicate, and they'll often indicate if within 2 minutes of searching, you can figure out how they like to engage. The other thing that I want to tell you is it's really important, not necessarily at this stage, but as you talk to other entrepreneurs, they can give you some insight into, oh, they're really great to work with. That one's a nightmare, don't talk to them. Don't waste your time. And as much as I want to say every investor is awesome, there are bad actors. There are some very bad actors out there. I have a founder that I've worked with, not that we're invested in, befriend, and it's the most awful, abusive situation I've ever seen, and I can't believe they got in the situation they got in, but it was a series of decisions over 2.5, 3 years, and it's like each one was slightly worse, and now they're in a spot where they're stuck. Like it's an awful spot, and the investors took advantage of that situation, inappropriately in my opinion. So, but had they probably talked to a couple of people that had been founders with them before, they would have either heard they're awful, run away, or it looks awful, but it's worth it, and here's why. Maybe? I don't think so, but maybe, right? You can get some pretty quick feedback on what it's like to work with different investors. So as you decide who to reach out to, don't waste your own time if they're schmoes. All right, once you want to reach out to them, this is a sales funnel. And if you don't know how to run a sales funnel, you need to learn now before you start this process, right? You need some kind of CRM tool to track who you're talking to. You need to get email systems set up so you can track what's going on. You need to define some stages. It's not rocket science, but you have to get that stuff organized before you go. Investors can tell when you don't have your shit together. It's pretty clear. And so often that first reach out that you're doing is, again, hopefully tuned to something that I said on Twitter or one of my team members said on Twitter or whatever. You're reaching out and you're honing in on something. You'd say, hey, I met you at that Greater Des Moines Partnership program. It was great. I was really interested in this piece that you said. I'd love to grab coffee and talk about my business. I'd be like, okay, cool, let's grab coffee. Easy. It's not scary. At least I don't think it's very scary. And I think most investors are pretty responsive to those things as you do them. Once you get a reply, though, this is the part that I think a lot of founders either don't figure out what to do with. You don't only send one email. You don't spam them every day. But you could say, hey, I emailed you last week, but I would love to chat with you because I really enjoyed your program with the Greater Des Moines Partnership. I'd love to get to know you a little bit. You can keep it pretty informal, but you need to be a little bit persistent. As an investor, you are the chief salesperson for your business, and a little persistence is kind of impressive, because if you're not, I'm not that excited. Now hopefully I caught it on the first one, we scheduled coffee, I sent you my calendar link and we're good to go. Like I hope that's how it goes, but don't worry, you're welcome to be persistent with investors. Worst case, they just don't reply, right? But once you do get them and you have an initial conversation, ask them if, hey, can I add you to my email list? This is a good indicator, in my view, of a discipline of a good founder. They've figured out that they have a list of people they're trying to communicate with. They have some information they're trying to send on a regular basis, and they're disciplined and organized about it. Because what you want is for me, when I first reply and say, yeah, we'll grab coffee next month because you're interesting but not that interesting to do it tomorrow. Then I get an email 2 weeks later of how you landed this first beta customer who's really excited about it and could be a $500,000 account, whatever, right? I start to feel like maybe I should have met with them a little earlier. What you're trying to do is to convince me that I should get my ass in gear and go. Like that's what you want to do. The best way to do that is a steady drip of progress that you're making, and you just set up that infrastructure that lets you have that communication going out to investors on a regular basis. So first week, maybe you meet with 2 investors. Can I put you on my list for updates? They say yes, you have 2 people on your list. Next week there's 4, then 6, then 8. And hopefully 2 months later, after you start getting some traction and you say, well, I'm expecting to get a term sheet pretty soon from a new investor I spoke with, and you send that to 32 people, suddenly people, if they're interested, they're gonna move pretty quickly. So you're trying to build that relationship with us over time, and it's pretty clear if that's what you're doing. Founders who do that well, they're gonna make some progress. Your initial pitch in the email, or whatever channel it is, if it's on Twitter or a quick whatever it is, not the pitch, but like your sort of elevator pitch, so to speak. Keep it simple, keep it straightforward, come up with a way to say it very simply and clearly. It has to be memorable and easy for me to remember. I hear many a day in many industries, make it memorable to me and simple. If it's too complicated, it's a bunch of techno stuff, like I'm probably not going to have it stuck in my brain. That's the whole, I need to meet with Eric Vinton tomorrow because he's really good. Yeah, it has to be memorable to me. And again, don't just randomly spam us, hit us with good stuff. All right, so then let's say I get your email, we agree to have coffee, you're sitting down at a coffee shop, you open up your laptop and you're giving me your pitch. Here's kind of how I see it. A pitch should be 10 minutes, but depending on the investor, they might have a 20-minute format. They might make you stand up in a room like this for their group. It's all different. Every investor is a little different. We're usually pretty one-on-one for the initial pitch. That could be on Zoom, it could be in person, whichever way. Typically, it's about 10 minutes, and this is really annoying to most entrepreneurs because they want to spray everything out on the table for me. And it's like, I don't need to know all the things. Right now, I need to get a sense of who you are as a founder, what your business is, whether it's worth me spending hours of my time to think about or not. Like, that's what I'm trying to do. It's sort of like Tinder, but I have 10 minutes to make a decision. So you need to give us a pitch, and you need to put it on the table and say very clearly what's going on. This is probably something I'm sure those of you in GIA are already working on, but later today there's a whole workshop on how to do it. 3 other pieces I guess I want to pull out here though. It should have some kind of a storyline threaded through it. And a lot of people point to Guy Kawasaki's 10-slide deck as sort of the template or a version of that, where here's the 10 things in every pitch deck. Yeah, it's true. The 10 things need to probably be in your pitch deck, or most of them. But they're not independent, discrete things, right? There is a story that pulls these pieces together. There's a narrative around them that flows through those 10 slides. So I'll be here this afternoon to talk about that. If the people up here don't, I'll give you my perspective on that as we do it. But one of the other things that I think has been going on recently is people instead, they send us a video, a 10-minute pitch ahead of time. I don't have to wait to have coffee with you. If I'm interested, I can just watch a 10-minute video, which is great. And then we have coffee and have a conversation. So consider what format makes sense, and you can kind of get a sense from the investor of what works for them. But that first pitch, this is what your purpose is, to get a second date, so to speak. And to be honest, you're trying to gauge the investor whether you want to go on the second date. Again, that you are the powerful person in the room. You want to decide whether the investor is right for you. So don't let that first meeting be completely one-sided, where it's you're dancing and I'm just sitting here watching. Like, you want to ask me some questions. So give me a founder I can talk to who's kind of like me to get a sense of what you're like to work with. Ooh, okay. Let me think about that. Like, that needs to be part of that conversation. It shows confidence and power. After that, we go through a series of deep dives, and depending on the business, this is different, but an example might be, I want to see your product, and then I want you to open up, Visual Studio and show me the code of how you're doing this. I want to get a sense of how you built this thing. Are you using proper technical patterns? Show me how you deploy your code on GitHub, or are you doing it kind of old school? We want to get a sense of the product. Then we'll say, bring out your financial model, the thing you're going to talk about later today. Cool, tell me why cell D32 on tab 3 is 7 times the price instead of 14. Why does that make any sense? Like, we're going to dig in on those things with you. Again, depending on the business and the stage, it's all different, but we're going to go dig and crawl into all kinds of things to understand your business very deeply. So what this means is, past the pitch, we're like, intrigued, founder seems legitimate, product seems pretty cool, maybe some early traction or whatever stage you're at that's appropriate for where you are. I'm now going to commit gobs of my time and my team's time to be on Zoom calls and other things and ask you for documents, and we're going to look at all that stuff to pull it together, including possibly your data room. We want to dig it apart. So it might be, help us explore your competitive landscape. Help me understand why you're going to win. And spend 2 hours in a phone call just talking about that. So this sort of process, depending on the stage and how much you're raising, obviously if you're raising $25,000, it doesn't go this deep. But for $1 million or more, like, it's complicated and it takes weeks often to go through all this stuff. And there's a lot of back and forth as we think about it. You know more about your industry than we do. So we're absorbing it and then trying to compare it to the patterns we've seen in other industries and saying, how would this work in your case? And just sometimes you're educating investors about how it works. If you're lucky past that, I shouldn't even use that word. If you've done a good job and you like the investor may send you a term sheet. And the term sheet's a summary of an outline of an offer. It's not binding generally. It's something that's just laying out an idea of how we could put something together. And your goal is to get more than one. Let me say it again because it's really, really critical. Your goal is to get more than one. In Iowa, it is common to get one, and you're just like, cool, I'm in, let's go. You want more than one, okay? What you want is 2 or more investors who have expressed interest in leading the round or being a significant player in your round, competing with each other to decide what the terms are. And you want to be in a position where you can somewhat negotiate that to your advantage, because Eric at ISA Ventures is giving me a better offer than this other venture fund. I would prefer to work here, but maybe we can pull that together. And if we still like the deal and the other person wins the lead, probably we'll still go. But what you're trying to do is to figure out how do you manipulate that situation so that the investors again realize that you are the hot commodity and we want to be in on that round and we're not the only option. Often what you're doing at that point is you'll have a bunch of investors. The most common answer people get from investors is, I'm interested, but tell me when you get a lead. How many of you have had that happen to you? Probably quite a few. Often, some funds are just not set up to lead, or they don't have the time to lead. So we're, as an example, a small fund. We might be very interested in your business, but like we're trying to lead 2 other deals at the moment. Like I just can't wrap my head around leading another one at that point in time. So it may not even be a reflection on you. Other times it's, I'm interested, but I'm just not that interested. Could be. And others just aren't set up for it. So angels often wait for someone to go do all that work so that they can follow along. So you're looking to soft circle them, and you keep a running list in your CRM system. You move in ISA Ventures over to the soft circle once we've got a lead. And then in that email that you're sending out to 36 people, you say, I've soft circled about $1.5 million of my $2 million round, just trying to pull together really this lead. I've got a lot of options. I expect another term sheet next week so I can make a decision. Again, you're building that momentum along the way. You need a good attorney by this point. If you don't have one already, there are a number of great startup attorneys in and around Des Moines, all around the state of Iowa. Happy to connect you with them. You've probably met them or will meet at least Joe Leo later today. He's a good guy, as an example, in there. But you need a good attorney by this point, because the moment term sheets start flying, you need to have somebody who understands your business and that you've retained to work with. As you do this, the last piece I want to put out here is I've seen some bad behavior. Investors who say, here's a term sheet, and you're like, ooh, looks good. And then they say, tell everybody else to go away. We're good, we got this. We'll help you pull this all together. We've got other investors. We'll just take care of this for you. And so you nicely say to ISA Ventures, Eric, you're adorable, thank you, but these guys, they're going to take this for me and do this. And then they string you along for 3 months or 6 months, and then you're out of money and you have nowhere to go, and they bludgeon you in the dark alley at the end until you accept their offer. You just be careful as you go down this path. Keep your options open, I think, is the real answer. It might be a good decision, but like, keep your options on the table. Don't preclude options to the extent you can. All right, a couple more things. Diligence and closing. So if you get term sheet, decide to accept one, this is where it sort of shifts a little bit into some of the other more detailed pieces of, from my perspective, we're going through and making sure all the corporate documents are properly formed, the intellectual property is assigned to the entity, and a bunch of other checkboxes. It's like 48 items long with deep connections in between them. Like, we have to do that as investors. It's annoying to you. It's way less annoying to you if you did that data room I talked about before, the deal room. You've set that stuff up, it's all out there already. It's not annoying to you at all, because I will go browse through the Dropbox and find everything on my own. If otherwise I gotta ask you 400 questions and spend hours digging through legal documents. You don't like that, I don't like that. You certainly want to do it more than once, so get that data room organized. We're also doing background checks. We'll call your customers, we'll call your cousin, we'll call whatever to try to figure out what we can about you as a founder. Some of you might have seen recently the situation with Fast. They raised some $100 million. They had, if I recall, $500,000 in revenue, and then they went out of business. And a couple weeks before, NPR had done sort of something of an expose on the founder, just some unflattering things maybe he had done in the past. Maybe it wasn't a big deal, I don't know. He seems like a smart dude, I don't know. But I don't know if maybe the investors didn't Google him very well. He was in Australia previously, maybe they just didn't look him up really well. I don't know, but like, that's the stuff we're doing. We're Googling you, and if somebody wrote an article about some stuff you did in Australia, we'd at least know that, and we might decide it's fine, we might decide it's a deal breaker, but like, we're looking into you as a founder and your background, so don't get offended when we do that. All right, one last piece. Often people think they're done once they've got the closing's done, the money's wired, all the documents are signed, yada yada. No, this is where it gets serious. You've got a board member now who says, cool, remember that projection you gave me last month that said you're going to hit this month? Yeah, how's that going? And you'll be like, I've been working on the closing, I don't know. Yeah, so immediately the pressure is on right there in board meetings and in stakeholder updates. You have to keep that going. All of the investors are going to they want results. They want to push you. So that treadmill you're on speeds up one notch right there. Be ready for that. All right, so a couple other details I want to share with you. real quick. Things that give me conviction, some of these I've mentioned. I want a pitch that's clean and concise and compelling. I often get the scientist pitch. I don't need the scientist pitch. The scientist pitch is later. Give me an understanding of the marketplace, why you think you're going to win, and to be totally honest, tell me why I'm going to make a bucket load of money. That's what I want to know. Like, convince me that's true. That's what we're here for, right? I need to believe that you can pull it off. So everything in all the communications that you write, that you speak, that you, in our meetings, you're giving me belief that you are the right person to do this at every point. And there's lots of little red flags and wobbles that will come up in any interaction. None of you, none of us is perfect. But you need to give me the belief that you're the one who can pull it off. Really crucially, as I mentioned, I'm looking at any number of deals all the time. Your mission is to convince me that yours is the best option I have on the table. A lot of founders think, I've got a good business, it's a viable business, it makes sense. It makes sense to me, and they're looking at it from that world. I'm looking at it in comparison to a dozen other ones at the same time. And if I'm like, if I could just have you in the meeting I was just in, so you could compare what you just told me to what they just told me, you would understand why I'm telling you no right now. Like, it would be so much clearer, but you can't see that, and I can't share it with you. So your job is to convince me that you're the best bet for me to spend time and invest my money in all the time. So keep that in the back of your head the whole time. And again, focused on that end game bucket of cash at the end of the day. Some things that cause deals to go sideways that are maybe things to watch out for. Don't lie, ever. Everybody understands you're making assumptions in your projections. Part of the game, part of the deal, it's fine. Do not lie. Had a couple of times where that happens and it's instantly, good luck, have fun with that. Had another one where a portfolio founder in the depths of due diligence at the very end called and said, I had 3 listed on my sales pipeline that I was sure were going to close. I labeled them 99% likely. One of them worth $1 million is not going to happen. Here's what happened. I just want you to know. Before the closing, that takes some guts to call an investor on the risk they might freak out and back out. But to be honest about it, it made me gave me more conviction about him than I had before. So do not lie. A cap table that's messy, as I mentioned, have it in Carta. Generally speaking, it's at least going to be organized. Later today, they may speak more about this, but had some really bizarre situations where, hey, there's this co-founder and they own 1/3 of the business, but they're not here anymore. Like, as an investor, that means 1/3 of the equity is kind of stuck off the table in a box, and nobody can touch it. You can't have it. It doesn't incent you anymore. It incents your business partner who's no longer there. Not cool. There are a couple of other variations on that, but if it's a messy cap table, and your attorney can counsel you on what a messy cap table looks like, but that's a pretty bad example. Bad prior investors. That example I mentioned before of somewhat abusive investors, like, it was clear within 10 minutes of the conversation, I was like, well, there's no way I'm investing in this, but you're my friend, so I'm gonna try to help you, but no, I mean, there's no chance. That makes the deal go off. Companies that have overly complicated entities, like, oh, there's a C Corp that owns an LLC which owns the intellectual property or something weird like that. It's just like, I don't have time to untangle this. Like, why? There better be a really, really, really good reason for something that complicated. The concept where it's a consistent failure to meet milestones. When we invest big in a company, we're looking for founders that have demonstrated, I can point my bat to the outfield, center left, and the ball goes center left, approximately. Like, I need to see that, and we're gonna ask you, cool, the last round, what did you tell your investors you were gonna do? Okay, cool, did you do that? It seems like a really obvious thing to ask, but it's one of the things we write in our deal memo for our investment committee. Here's their evidence that they know what the hell they're doing and can at least reasonably predict where they're going. It's never gonna be perfect. If there's delays, I get it. The other thing that I think is a really big red flag to us is companies that are sort of in constant bridge mode. It's convertible note to keep the thing alive, to get to some unspecified place. Like, it makes it really hard for us to look at that and think, does the founder understand the milestone they need to get to? Either they didn't raise enough, or they were unable to do what they said they would do, one or the other, and they get in kind of this weird bridge spot of, like, just asking for more money all the time. It makes it really hard for us to think, oh, cool, I'm gonna swing $1 million on this one. So those are some examples of things to watch out for if you can. And sometimes it's unavoidable, but that's where you're at. One last quick thought that I don't even think I've baked all the way. Once you do raise the capital, I've been a founder, 15 years as a startup founder. It's hard once you raise money from investors. Your ability as a leader to grow in a startup company is hard because even whether you bootstrap or raise capital. But the speed at which you have to grow as a leader, as a person, as a team is amplified 3, 5, 10 times as fast. And it's hard. It's hard anyway, but you need to be ready for that. This is going to come at you like a freight train. Once you've raised significant capital, the expectations of you as a leader are just made that much harder. You don't have the time to wait to figure it out. You have to hire a group of people around you who are incredible, and you have to find them, and they have to believe you and want to be a part of your rocket ship, which is hard to do. It is not, especially if you've never hired incredibly smart, expensive people before. If I invest money in your company, I'm expecting to find a CFO who's phenomenal or a COO who's phenomenal, and you have to go find them. And often that's really uncomfortable, especially for first-time founders who've never built a team like that before. How do you find those people and convince them to work with you? I've mentioned some board governance situations. We have examples of founders who the board moved along. The founder is out, or the board is complex and political and maybe emotional. And as a founder, you got to figure out how to deal with this. You got your business running, maybe it's on fire, and you got your board over here saying, your business is on fire. You're like, I know, I'm trying to work on it. And there's like, give me some documents, give me some spreadsheets. And there's like this balancing act, right? Well, this is my board, right? They're the ones who are helping me guide this business. But I've got my business over here, and there's often tension in those things, and just be ready. That's not a trivial thing. You don't get to be like, I'm gonna have a cute board meeting and 20 minutes or an hour of my life, or a couple hours, I'm good, every quarter. Like there's a lot of relationship building and structure there that you need to be prepared for. A lot of founders are caught flat-footed. And then investor relations generally are complicated. Investors want their money back. They have different expectations. They might not remember what the expectations were when they invested and think that you're supposed to give them their money back this year. And you said, no, 2027, dude. So you have to manage those relationships over 5 or 10 years, and that stuff is complicated. So just some things that happen after the fact that are worse or more challenging for you that often people don't think about. Cool. All right. It's hard to do, but it's awesome to do. And I know I ran up to my time here, but happy to answer questions or now or later. If you have any. Yeah, Derek.
What are your revenue expectations in a seed round? Like a range or?
It depends on the company. So we have two classes. I think we've sort of split them into. One is companies where there is no revenue expectation because it's a research project. Those are unusual. We have 2 or 3 of those where it's just like a massive regulatory burden they have to go through. It's a pharmaceutical product or something that has to go through some FDA stuff or something. There's 0 expectation of revenue in those at the seed round. For other companies where I would say probably like yours, where I think you should be able to generate revenue, we're looking for not so much an absolute number, because if you're selling a $100,000 product or a $10 product, that answer is very different. I think what we're looking for is indications that the customers want this badly. And it might be we closed 100 transactions last month and then 1,000 the following month, or some kind of a curve like that starts to hint at something awesome. For us, that's still a small investment, typically 75 to 100K in the seed round for our fund. We don't bet a lot at that stage. We bet a lot of time. You don't bet a lot of dollars in the absolute money in a single company at that stage. At least in my opinion, that's what we're looking for, is evidence people will buy it. That's the distinction for me from pre-seed. You sort of have an assumption people will buy it at pre-seed, and we're kind of funding to find out. If any of you play poker, I sort of think of pre-seed as it's the ante, because I just really want to see if I can see the flop for free and decide if I bet more. That's kind of what we're doing at that point. Does that help? And it's sort of a non-answer because you asked specifically how much revenue, but it depends is the real answer.
I have 2 questions I think are relatively quick. One is, you mentioned you look for a monster market. I'm assuming that answer might be it depends on in terms of size, but can you define the dollars of a monster market?
I think the VC shorthand would be a plausible billion-dollar opportunity. There's a really great piece out there. Maybe I'll send it to Diana after this if she wants as a way to share with all of you. But it was basically this guy taking apart Uber early on, saying when it was first what Uber first was. Uber was not what it is today. It was, black car service, and he wrote, here's maximum market size, and he wrote this whole thing about it. And then, kind of looking back at it later, as a venture capitalist, would I have seen what Uber could become to see how big the market could be? And so often you're as a founder, like you're trying to figure out, here's what the market that I'm going to attack today is in my milestone, right? It's sort of step by step. First, I'm going to take this slice. This slice gives me a base to work from so that I can get to this one. But then I get to my $1 billion market here. Nobody expects you to tackle $1 billion early on. And again, that's where strategy comes in of there's an intentional sequence that makes sense to get where I want to go. And I want to see that come through. But $1 billion, I think, at least as a plausible, would be a good way to think of it. It doesn't have, in my case, it doesn't have to be $1 billion. But for some funds, the math only works if it's $1 billion. But in Iowa, I'd say that's not necessary. Yeah.
I have one more, it's okay.
I'll do red shirt guy, and then standing up gal, and then back to you. That's okay. Sorry, I can't see your name tags if you have one.
I don't have anything. I don't red shirt guys are great.
Okay.
You mentioned if we could, ideally want to get multiple term sheets. If we're dating a lot of people at the same time, they might not all accept our engagement offer at the same time. How long is it reasonable to say to somebody who's expressed interest, sit on the bench for a while, we got to talk to these other people?
I think that answers might be different in different markets at different times. In Iowa, if you said, Eric, I appreciate the term sheet. I know I'm expecting one other from another investor in the next 7 to 10 days. I would say, that's disappointing. I thought maybe I had this one locked up, but I understand. And so, cool, 7 to 10 days is cool. Something within a short matter of days. So you kind of have to orchestrate that in a fairly careful way. You can't say, I want 6 months to think about this, because I moved on by that point. I've found somebody else at
So
that
we can
time.
stack up pitches as quickly as close together.
You want to, the seriousness you want to try to stack up so that you get a couple of term sheets in short order. And again, by telling somebody, Eric gave me a term sheet that, you don't tell them what it was. You tell them you got a term sheet, and then somebody else gives you a term sheet, and you're like, oh, idiots, I don't want that. Another one comes in, ooh, that's better. That's what you want. So you're trying to be in a position where they, as an investment, what you want is for me to know that you got a term sheet from someone else. I don't know what it is.
And I assume that there's a longer, more leeway there if they've said, I want to invest, but I don't want to be a lead. Then I'm guessing they're willing to sit and wait.
Oh yeah. And that's kind of how you bucket them. So in your CRM, you've got your soft circle group of people who are kind of along for the ride and interested. They're probably going to invest if there's a lead within some reasonable range of valuation. I got 28 of them, and I got 3 that I'm sort of chasing for a potential term sheet. 2 that I really like, that I prefer, for example. Yeah, you kind of think of them a little bit separately. Yeah. Curious if you have other thoughts to add on that, or in your experience, it's been similar to that.
Yeah, I was kind of smiling at that. The first, I think you're spot on with regards to wanting to get multiple term sheets. We've been primarily following in the investments we've made this year. So we have a soft circle around this. But we are, the ones that we're looking to lead on, your timing is pretty appropriate.
Okay.
And we'll get back really quickly. If we want to establish our reputation, we'll get back quickly to an entrepreneur kind of who's pushed us within a couple of days, if not within a day or two, if we're interested or like passive. And if we want, when we tell them that we're interested, we typically tell them we're interested, but we're going to follow, or we're interested.
Glad we're generally on the same page. That's good. What was your question? Tina, thank you.
A couple of questions. One, so the major difference between the angel investors and the venture capital is more like a pre-seed versus seed?
Oh, and the other big difference is in the angels case, they're investing their own money. In a venture fund, I'm investing somebody else's money.
So it's more like an independent investor, because we do have an angel investor group, a couple of groups here, right? So they
There are.
pool together like this?
There's a couple of models. The most common one that I've seen is the angels all independently hear your pitch. One of them says, I'm interested in helping do some due diligence and pulling a deal together. Is there anybody else who's interested? And then they all kind of come together. But ultimately, they're each investing their own money in your company, typically.
Okay.
It's often easier, well, easier is maybe not the right word, but like the diligence they're going to do is generally much lighter than a firm that has a staff that does it full-time all day, generally speaking.
And then how do you find investors in your fund? Is it capped? Do you have people rotating in and out?
Yeah, so most funds are closed funds. There are a couple of other versions out there, but most, when you think of a VC, it's usually a closed fund like ours. So we are closed and done. We have 22 million to invest, and I know who all the investors are, and they're friends of mine now for the next 9 years, maybe longer. So yeah, it's locked up, but yeah, I have to go find them first, generally speaking, yeah, before we can, at least we have to hit a minimum threshold before we can begin investing. We started investing after we hit 15 million.
Okay. And then alongside other Iowa VC firms, do you guys collaborate on different deals that they're investing in and you're investing in and have those conversations? Or?
For sure, yeah, and certainly in a state like Iowa, all the venture funds know each other. We've already co-invested on multiple deals together. We all can text each other with questions. What do you think of so-and-so? Like instantly. So yeah, it can be good or bad for you, right? It can pull a whole bunch of people together really fast, or if one of them has a really bad interaction with you, like, I thought they were morons, don't talk to them. Like, it can go that way. I mean, investors will make independent decisions anyway, and we disagree. Sometimes I'm like all in on something, and another fund in the State's like, that's crazy. We'll see someday. But yeah, we do talk to each other.
Okay, and then how have you seen the market change for you as a VC?
I'm young in the market, so I don't know how to answer that with any sort of definitive sage perspective. I think in Iowa, what I've seen over the last 7 years, 8 years that I've been kind of working with startups, there's definitely been a maturing happening. Like in 2014 when we first started this, most people had no idea what a safe was. They were extremely rare, even though it was a common use on the coasts, for example. The investors are generally smarter and better just because they've learned. The founders are smarter and better because they've learned. We have great accelerator programs all over the state. There's ecosystem construction that didn't exist in 2014. So like it's better in every dimension. But I also know where other communities are around the country, and it's like, oh, we have so much further we could go, but gosh, we've made so much progress. It's sort of a pride, but oh, we've got a long ways to go too. Things we could do better for founders. Yeah, appreciate that question. Darren, did you have one more?
Yeah, one more. So as a founder, I think my biggest struggle in raising money is I don't want to negotiate against myself when it comes to how much money I want to raise and how much equity I want to give up.
Yeah.
But inevitably, that's where that's the question is, well, how much do you need? And if I get a term sheet, how much equity? Do you have any advice that is founder friendly from the investor perspective about how do I toe the line without shooting myself in the foot by asking for too much money or by not willing to say how much equity I want to give up?
So yeah, that's a fair question. You're not asking for money per se, right? What you're saying is I'm looking to raise $2 million to reach this milestone. As part of that, I'm looking to, give up some percentage of the business because I want to make us all a lot of money someday. And so, I'm kind of aiming at the, 10-ish or whatever percent, whatever you want to say. There's some negotiation strategy of whether you want to be first to put a number on the table or you want to wait for the VC. But to be totally honest, as a founder, your time is precious. So I would do it like the initial pitch. If the pitch goes well and they're like, oh, tell me more about this, at the end they're going to say, all right, so what are you looking to, how much, what are you really thinking here? And you can put like a range out and say, for the right investor, I'd be willing to do something like this, in this range. Yeah, I would just save my own time, even if, especially if you like them.